We're recording this right after the July 4th holiday, and after having set several new all-time highs, both in the S&P and the NASDAQ, the market is selling off. And for those of you who are not back in the market, who are still suffering from the April meltdown that came with Liberation Day and the announcements of global tariff imposition by President Trump,
right?
it's time to be in the market because all-time highs are actually good news. My name's Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
So one of the main drivers for all-time highs is referred to as FOMO, F-O-M-O, fear of missing out. And usually FOMO is a major problem for individual investors. They got beat up in some recent drawdown, and at the bottom, they finally caved and pulled their money out. And they have no rules to decide that they should have gotten out earlier, much less decide when to get back in. But
Right.
2025 is an exception. It's an exception because institutions are the major victim of FOMO this year. When President Trump announced the tariffs were going to be imposed across the board at very high rates in many cases, institutions said this is bad for the economy, both in the U.S. and around the world. We are going to take a defensive stand, liquidate positions, protect profits, build capital, and get ready for a long, nasty summer, because summer is when you sell in May and go away. So these guys did just that. They sold, they went away, they prepared for a long summer vacation. And in a few weeks, the market is setting new ratcheting up off the bottom. It took a month to get to new highs, but they're now dealing with underinvested institutional portfolios, waiting for the next pullback so they won't be embarrassed at how high it was for them to put their money back to work.
It's an amazing thing. It really is a classic example of Wall Street getting caught reading their own headlines. And it just fed on each other. Every article had to be worse outlook than the last one. Tariffs are a disaster. They've never worked in the history of humanity. We are going down the drain here big time, faster than anyone can believe. We're heading for the hills. And they all did. And then nothing happened except good stuff. Oh, we're still going up. Now what are we going to do? And like you said, Don, people need to remember that fear is not only on the downside. People don't just get afraid when things are heading down. They get afraid when things are heading up and they're not in. Now they're afraid to make the move because they don't want to look like, well, I'm just following the crowd. I'm going to jump back in, then this thing's going to tank just like I said it was, and then I'm really going to look stupid. So they do nothing and they just get paralyzed. It's a deer in the headlight, and they don't know what to do. It's just a classic example of, if someone is always telling you, hey, the guys on Wall Street, they know what to do all the time. They don't. They're no different than anyone else. They make big mistakes, and this one has not been a good at bat for the Wall Street advisors.
Well, and many of the hedge funds are both long and short at the same time. They're buying one position, betting it's going to go up, and they're buying another one, betting that it's going to go down. So they sell it short. The problem is that they're having a hard time trying to figure out which ones are which right now, because there's so many things that are going up. You have to dig harder to find something that's collapsing, or that they expect is going to collapse significantly more than it may have already done.
Absolutely.
So it's a real conundrum. So as an individual investor, if you are frustrated because you're not in the market, you're not alone. And the question is, should you be in the market? Well, the answer is yes. It's a function of what are your rules and how do you make the decision to get in. Well, we basically use momentum and trailing returns. We keep track of how well different assets are doing. We have a watch list, and for different portfolios, we have different watch lists. The question is, do you have something that's developing and maintaining leadership? If so, you want to keep that. If it's falling out of favor because money's rotating into another sector or another industry, and it's starting to slip. Why do you keep it in your portfolio? As Warren Buffett says, diversification is for people who don't know what they're doing. So maybe if that's you, you want to just say, okay, I'll leave it there and I'll add something else that looks different. But we believe that it should be systematic decision making based on rules, both getting in and what's going to force you to get out, so you do not get married to a particular investment.
Especially in times when there's so much investment noise out there. I mean, people get very concerned about things like tariffs. We got them right now. Wars, got them. High valuations, check, got all those things. And you can talk yourself out of a perfectly good investment by just following the narrative and saying, you know what, this is too dangerous. I shouldn't be in this, instead of looking at the data and saying, well, no, these things are a concern. We should watch them. Right now, they're not really affecting that market that much, and they're certainly not affecting the market long term. And that's the key. They're generally fairly quickly in and out of the market effect wise, except for exceptional happenings. And we're not seeing those right now. So it's like, yeah, another part of a war will break out, and it's like, well, that's it. We're done. Usually not. Usually those are fairly short-lived events, and you shouldn't let those push around your portfolio. If you've got the rules in place and you're tracking the data, you can look at that and not listen to all the noise, because the noise gets so intense. Like I said, Wall Street just talked themselves out of being in good positions in a good economy with good gains coming, because they listened to their own headlines. They followed their own narrative that they invented, and then found out, well, it doesn't really line up with reality, but we're kind of stuck right now. So that's what we're going to do for the short term. And we're just going to take a beating because we don't want to look dumb. And you never want to have yourself in that situation.
Well, the big major banks also have political biases. And
Sure.
so they let that influence their decision. Many of them did not like the election outcome with Trump being elected. Many of them were very vocal. They did not like his tariffs, and they did not like his big, beautiful bill act, either any of the three. So
Right.
they had a negative bias looking for the bad news, trying to find something to justify what they were doing in their portfolios. And it backfired on them. Data, however, is price rising? Is price falling? How much? How far? That is not debatable. It either is or is not. That can form a decision or create the basis for a decision that does the best you can to step aside from your personal biases.
Correct.
Biases get you in trouble because they're an emotional response to events rather than looking at market, which in the bottom line is all about math. Even if you're a fundamental or a value investor, you're looking at
Yep.
math. What's the price book, price earnings, price sales, I mean, cash flow, free cash flow, before and after taxes? It's all math. And investors are anticipating that earnings will either grow, be flat, or shrink. And based on that math, they will adjust their position in their portfolio or remove a position entirely. That's data that you can process systematically with discipline. Just because you have a system doesn't mean that it will work unless you in fact have rules for how often you run the calculations to be sure something hasn't fallen out of bed.
Absolutely. And our process, just because it's disciplined and it follows data, which it does on both cases, doesn't mean it's always right. The market is not ever obligated to follow the rules that you think it should, and that's true with our process also. But most of the time, it does. So it's going to give you the best chance, the highest probability of being on the good side of a trade. And so more times than not, you're going to have profitable trades. You're going to stay in them longer, and you're going to cut them loose when you need to. It's just that no process is correct all the time. It's never going to happen. Tracking data, ignoring the emotional drivers in the market, and following the money, where what's attracting money right now, and avoiding the places that aren't. Those things give you the highest probabilities of being on the good side of a trade, and that's really as good as it gets. That's the best you can hope for.
So, with the discussion around all time highs of this last couple of weeks,
Yeah.
there's a number of things that have basically happened. We had a significant, extraordinary sell off with Liberation Day and the tariff announcements. It
Right.
did not last long. It was deep and sharp, but it turned around quickly. And as it turned around, there were periods every week or so where it looked like it was going to come to an end, and then it would rally again, and it looked like it was going to come to an end. The market would start to go sideways for a few days. People thinking, the left out people thinking, here's where it's going to pull back and I can enter. And then it jumps up, rallies again, and they're
Right.
waiting for another pullback. But so we reach new all time highs, and you're waiting for another pullback. Historically, whether you're looking at individual stocks or sectors, all time highs generally are followed by more all time highs. We
Correct.
saw that after the COVID crash, one after another after another. And then you reach a point where you do have some profit taking in among investors, and the fundamentals, corporate earnings may be challenged, get an economic slowdown, some sector rotation occurs, and that particular industry or a stock goes sideways, pulls back a little bit, but consolidates before it takes another move up. So
Sure.
since the bottom in April, we've been in what's called the velocity market, one with continually rapid price appreciation. As we hit these last all-time highs, new all-time highs prior to the 4th of July, it should not be a surprise, given the rapidity of that rise from the bottom of April, to see the market move sideways for a little bit and people just take time to say, is this real? Can this go on? How is AI really going to affect this? How are tariffs really going to affect this? Well, the tariffs are bringing in a ton of money that was not expected. And as we
Correct.
pass the new bill, the big, big, beautiful Bill Act, the CBO gave no estimate whatsoever for the tariff revenue that's already been recognized. It's basically saying tariffs bring in zero revenue. Well, that's a hard bit of data to build a foundation on
Right.
when you're looking
Right.
at just the opposite. So this is where data makes a difference, but you have to have good data. And the best data is the stuff you can see yourself on your own screen, which means you got to do a little work.
You do have to do some work, and you do have to be honest. That's the toughest thing. If you're already biased, like you said, Don, those biases are so dangerous. If you're a dyed in the wool bull, you're going to go out and find data points that confirm your bullish outlook. And if you're a bear and you think this market's going to tank, you're going to go find those data points that will reinforce your own point of view. And those kinds of biases will just sink your ship. You need to be honest about the data. Look at what's going on. Take a step back. Look at a bigger picture and say, hey, what's really going on here? And then address it like that, and don't be stuck with a point of view. Like you said, Don, never get married to an investment. Nothing's going to be right forever, including your pick on the direction of the market. So believe that data when you see it coming in, and if it changes, change with it later, but don't ignore what's going on right now.
So if you want to talk with us about your portfolio, you've got questions about what you own, we have opinions on it. We have data. We'd be glad to share our opinion with you, show you what our data is based on your portfolio. We don't need to know how big your portfolio is. It's just, what do you own? What are you worried about in your portfolio? Give us a call, send us an email. We can do an online conversation with you. We just talk on the telephone, whichever you're more comfortable with. Contact information's on the screen. Thanks for being with us, and subscribe. We will have more coming up following this podcast. Have a great day.